So today we're going to unpack a topic where the two parts seem, like distant cousins at first glance. Global trade policy and your annual insurance premium.
It's not really a jump, though. It's a direct, almost mechanical chain reaction. We're talking about decisions made in Washington or Beijing landing squarely on, say, the repair bill for your car.
Or the cost to rebuild your roof after a storm.
Exactly.
And we can trace that because our listeners sent in some fantastic sources. They detail the projected economic ripples from the anticipated 2025 tariff regime.
Right, and these are big ones. Tariffs on cars, on construction materials, goods from Canada, Mexico, China.
So that's our mission for this deep dive. Connects those huge policy shifts directly to the rising costs, the higher premiums, and even the changing coverage options you're going to see.
And this isn't just abstract economics. It's really about risk volatility. Tariffs are creating these considerable headwinds for insurers. They're inflating costs and amplifying economic uncertainty.
And the industry has to adapt. So here's where it gets really interesting. We're going to trace, step by step, how a tariff on Canadian lumber can actually change your homeowner's policy.
And it happens fast. I think to really get it, we need to start with the plumbing of the insurance business itself. The sources point to 7 key ways this all works.
Okay, let's start with that fundamental link, the transmission mechanism, as the industry calls it.
Yeah, and what's fascinating here is how immediately a change in input cost translates into what they call higher claim severity.
So a more expensive claim.
A much more expensive claim. Think about a car accident. Tariffs raise the cost of imported spare parts, all the little sensors, the electronics. The same thing happens with building materials or medical devices. So when an insurer has to pay more to replace a part,
the cost of that single claim just spikes.
It naturally spikes. And because insurers are constantly trying to predict future costs, this leads right into the second mechanism,
which is anticipatory pricing. They aren't waiting for the costs to actually hit their balance sheets, are they?
No, they can't afford to. They are legally required to hold enough capital for future claims. So they're baking in these expected cost increases, one source called them pre-baked assumptions, into their rate filings right now.
So the premium hike you might see this year is actually based on what they think tariffs will cost them next year.
That's it, yes. They're pricing in that future inflation before it's even fully felt. We've already seen this in health insurance, actually.
Oh, really?
Yeah, rate filings that explicitly mention tariffs on pharmaceuticals or medical components as a direct reason for asking for higher premiums. Regulators see it as a quantifiable risk.
Because if they underprice the risk now, they could go insolvent later.
That's the nightmare scenario for everyone.
Okay, so that's how they price it. What about how they protect themselves internally? That brings us to mechanism 3, tighter underwriting.
This is their classic defensive move. When risk gets volatile and unpredictable, insurers have to stabilize their own exposure.
And that translates to us seeing higher deductibles.
Higher deductibles, yes. Or tighter policy terms, new exclusions. In really extreme cases, you'll see carriers just exit a market altogether if it's too exposed to tariff risks. That reduces competition, and, well, you know what that does to prices.
Right. Now, what about their own money? Mechanism 4 is investment and capital stress.
A huge piece of the puzzle. Insurers rely heavily on investment income to offset what they pay out in claims.
And tariffs make the markets choppy.
Exactly. That volatility weakens their returns, especially in equities. So now you have this strain on their capital. They have to make sure they have enough liquid cash, their reserves, to pay claims today.
But if their investments are worth less,
and at the same time their claims are costing more because of those input costs,
they have less of a buffer. It's a squeeze.
It's a fundamental stability issue. And that brings us to the 5th mechanism, which is about the wider economy. Macro feedback.
Meaning if tariffs slow down the whole economy,
then businesses need less insurance. Fewer workers means less workers' comp. Fewer construction projects means less builders' risk insurance. So their premium growth just stalls out or even shrinks.
Which is happening right when their costs are going up. That's a serious problem.
It is, and it ties directly into number 6, reinsurance pressure.
Remind us what reinsurance is.
Reinsurers are the insurance companies for insurance companies. They are the financial backstop for the whole industry.
So if my insurer gets hit with a ton of massive tariff-inflated claims,
they turn to their reinsurer. But the reinsurers see this happening across the board, and they recognize their own risk has just shot up. So they respond by raising their prices, tightening their own terms, or even reducing the amount of coverage they'll offer in certain areas.
And that cost just gets passed right back down the chain.
All the way down to you,
Yeah.
which leads to the final mechanism, number 7, regulatory constraints. If premiums spike too fast because of all this, regulators get involved.
Of course. Consumers complain, politicians get pressured.
And you might see rate caps or a moratorium on increases, which, sounds great in the short term. But if insurers are forced to absorb inflation they can't cover, they'll just stop writing policies in that state. And then you have a real market crisis.
Okay, that gives us the 7 points of pressure. Let's make this more concrete. Let's talk about specific lines of coverage, starting with the one most of us deal with, auto insurance.
This is a massive exposure. I mean, the global supply chain is just everything in collision repair. The key fact here is that more than half of all U.S. auto parts are imported.
Everything from sensors to bumper assemblies.
Everything. And if those parts are hit with tariffs of, say, 25 to 50%, the cost to repair a car just explodes.
And it doesn't matter if it's an OEM part or an aftermarket one.
The severity increase is immediate. A headlamp on a modern EV has incredibly complex foreign components. Slap a 30% tariff on that, and your insurer is paying that cost. The numbers in the source are pretty stark.
What are they projecting?
Insurers are expecting auto premiums to go up by 6 to 10% or more in 2025, and that's just from these tariff-driven repair costs.
6 to 10%. That is a huge jump for a single external factor. And there's a secondary effect too, right? Something about logistics.
Yes. The supply chains themselves get disrupted. So your car sits in the body shop for 6 weeks waiting for one specific part. That delay inflates labor costs, rental car costs. All of it is borne by the insurer, who then passes it along.
Okay, let's move from the garage to the house. Homeowners, property, construction insurance.
The logic is exactly the same, but the scale can be much larger. If your house has major damage, the cost to replace it is now structurally higher before the first nail is even hammered.
Because of tariffs on things like lumber.
Lumber, especially from Canada. But also steel, copper, glass, even major appliances. All of it directly raises rebuilding costs.
The numbers on this in the sources really caught my eye. The National Association of Home Builders estimates that existing tariffs have already added somewhere between $7,000 and $11,000 to the cost of an average new home.
Right. And that is the sticker shock that applies to any major repair. That number is staggering, and it changes the whole foundation of how risk is calculated.
So the warning for you, the consumer, is critical here.
It really is. If you had, say, $300,000 in coverage on your home last year, and now it costs $315,000 to rebuild because of these material costs, you are instantly underinsured.
And that problem gets way worse in areas prone to natural disasters.
Drastically worse.
Okay, what about health and medical costs? How do tariffs get into my doctor's office?
It's still about imported inputs. Specialized medical devices, components for diagnostic equipment, the raw ingredients for pharmaceuticals. The higher cost for these goods pushes up overall healthcare costs.
And for insurers, the main issue is the unpredictability of it all.
Yes, that's the key. Unstable pricing forces them to be more cautious, and that caution translates directly into higher premiums.
So the source suggests that in the small group and ACA markets, insurers might add a 2 to 3% premium increase just as a buffer.
Exactly. You can think of it as a volatility tax. It's an increase that's calculated before a higher bill even lands, just because the risk of a tariff shock exists.
Let's touch on commercial lines then. This affects basically every business.
It does, and it raises a really important question.
Right.
What happens when the supply chain itself is the thing that's becoming uninsurable?
You're talking about things like business interruption insurance.
Business interruption, supply chain insurance, yes. BI coverage pays a company when their operations are disrupted. But now tariffs are causing disruptions. If a key imported machine part is delayed for months and a factory shuts down,
the insurer is on the hook for all those lost profits.
Right. So the risk of these cascading failures means carriers have to either raise premiums on that coverage through the roof or just stop offering as much of it.
So we've laid out the problem pretty clearly. Let's pivot to the responses. What can the industry do? And more importantly, what should we, the policyholders, be doing?
For insurers, it's a fundamental shift in how they model risk. They can't just rely on historical data anymore. They have to use forward-looking rate models that actively game out scenarios for these tariff-induced inflation shocks.
So they have to become trade economists, basically.
In a way, yes, it's a huge challenge, but it's necessary. This allows them to make dynamic underwriting adjustments. So modifying deductibles or applying special surcharges for policies with high tariff exposure.
The sources also mentioned diversification as a strategy.
Indeed. An insurer can get a competitive edge by focusing on industries that are shifting toward domestic sourcing or that have less exposed supply chains. They're basically using their models to reward clients who are less exposed to trade instability.
And what about just controlling their internal costs?
That's the other side of the coin. They have to streamline their claims management, negotiate huge bulk pricing agreements for parts, and really encourage using high-quality substitute parts when an OEM component is just too tariff exposed.
Okay, now for us, the policyholders. The first order of business, and the most painful, is expect to pay more.
That's the simple truth. Expect and budget for higher premiums across the board. Auto, home, business.
And beyond just budgeting, you have to actively manage your own risk. That might mean raising your deductible to keep the premium down.
It might. But the most crucial warning from all the source material is to be vigilant against underinsurance.
We mentioned this with homes, but it's that important.
It cannot be overstated. If rebuilding costs jump by $10,000 or $15,000 in 1 year and your coverage limit doesn't move, you're leaving yourself dangerously exposed.
So you need to be proactively checking your policy every year.
You have to. You need to make sure your coverage is keeping pace with these rising material costs. If you're not, you're effectively self-insuring that gap.
Okay, let's zoom out one last time for the big systemic risks. This isn't just about individual claims, it's about the whole ecosystem.
Right. Risk one is that demand compression we talked about. A slower economy means less premium growth, which would lead to market stagnation.
Risk two is what you called the double squeeze.
That's the nightmare scenario.
Nah.
Poor stock market performance reduces their investment income at the exact same time their claim costs are rising. They're getting hit from both sides.
Risk three is that regulatory backlash. Rate caps that stop them from pricing for the actual risk they're facing.
And finally, risk four is that big companies might just opt out. They get frustrated with the volatile pricing and turn to alternatives like self-insurance or something called parametric insurance.
How does parametric insurance work in this context?
It's fascinating. It pays out based on a pre-agreed trigger, say a tariff on a specific good hitting a certain percentage, not on the actual calculated loss. It simplifies the claim, but it means pricing for pure volatility.
So we tie this all together, the 2025 tariff regime is really a massive stress test for the entire industry.
It is. They can no longer assume stable input costs. They have to actively rethink everything: pricing, underwriting, capital strategy, just to navigate this new level of volatility.
And for you, the listener, the takeaway is pretty clear. When you see a news story about trade policy, you should immediately start thinking about the impact on your own bottom line.
Whether that's at the repair shop, the lumber yard, or even in your health insurance bill.
Which leads us to our final provocative thought. The source mentions that insurers who can monitor these shifts toward domestic sourcing will have a competitive advantage. So, if insurance profitability becomes more and more tied to stable supply chains,
will future policies start to actively reward businesses or even homeowners who can prove their exposure to imported goods is minimal? Could we see a future where risk is fundamentally reassessed, based not just on what you own, but on where its component parts came from?
Thanks for listening to today's episode. No matter what type of insurance you're looking for, home, auto, business, or specialty coverage, Blue Rock Insurance Services is here to help you navigate it with confidence. If you need guidance, quotes, or a second opinion on your current policy, reach out to us anytime. We're here to make sure you get the protection that truly fits your life. Until next time, stay safe and stay insured with Blue Rock.